Good morning and welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite, we have Andrew Arman. He's with the ETF Trading Solutions Group over at WallachBeth. It's great to have you back with me at MarketSite, and I'm sure you're getting this question a lot. Is it time to start reallocating some U.S. assets right now?
Yeah, perhaps. I mean, what a ride it's been the last couple of months, right, with this volatility. And I haven't seen anything like it in the 18 years that I've just been looking at screens. So I think you can look at it two ways. For those that don't want to do it, for those that aren't ready, right? Because if you're not rules-based, you don't know when to react, when to get in, when to get out. There's a lot of political movement that moves the market around. So cash parking, one of the trends we've seen is yield, right? And the JP Morgan ultra short-term yield has had a ton of inflows, over $5 billion, and only 1 day of outflows or redemptions the whole year. There's a reason for that. The short-term yield curve is actually inverted. So you actually get a higher yield than the midterm time frame with the dampened volatility of a shorter term. It's about a 2.34% yield, and the expense ratio is less than 20 bips. So we've seen a lot into that. And then, of course, there's some other things with if you want to put risky risk.
Investors are so used to getting a return on their assets that they might be hesitant just to put it in cash.
Right.
And they're looking for vehicles where they can get some kind of yield.
Some kind of yield, right.
Now, do you think it's time for U.S. assets to relocate to foreign assets, or there's a lot of global uncertainties out there?
Sure, but it's already down 30%, right? I mean, many of those Asian markets are down 30%. We don't want that to happen to the U.S., right? And it's been a rough couple of years for, let's say, asset managers and investors that have to focus, or maybe part of their mandate is Asia or emerging markets. So one of the things is maybe it's time. With down 30% and you feel like it's kind of bottomed out a little bit, and I'll give you an economic reason in a second, but if you look, the IEMG is a cheaper version of EM. I mean, it's a different portfolio. It's a core emerging markets, but it's mid-teen bips versus EM, which is almost 70. So it's a 0.5% there, and it's a core portfolio. So you're taking single stock risk out like with most ETFs. And you can relate it to the US. So let's say rates either start to come in or they don't raise rates. Well, that will depreciate the US dollar, which will then in turn rise the Asian markets back and forth with the trade. So,
well, to wrap up here, you said you have not seen a market like we've experienced over October, November, and I would even argue December. It's not common to see the markets like we saw in 2017 just go straight up.
Correct.
But it's also unusual to see these 4 or 5% swings midday.
Yeah.
So the Dow up 350 at the open to go down to 200, then to finish up 100 points. That's kind of unusual too.
It is. I would say welcome to the new norm.
Right.
For volatility. Of course, when it's not volatile, we won't do that. But when we have moves today due to the nature of how we operate with information and technology and who trades. There's trading shops that are set up just to trade. It's a different economy. So I would expect when you have moves, then they continue to be fast intraday. Things that took a month, 10 years ago took a week. Today they take a day.
All right, Andrew, thank you so much for joining us at MarketSite. And thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.